Hello again, traders. In this training video, we're going to talk about trading in ranging markets. If you're a trend trader, one of the strategies you may have is to simply wait out the ranging market when it's consolidating, wait for a breakout, wait for another trend to be established. If you're a counter trend trader, you actually like to see consolidation after a trend because that may signal a potential trend reversal. And the other option is adapt your trading plan and trading system to simply take advantage of a ranging market. And for that, I suggest that you drill down to a smaller time frame. Traders, the markets only trend 30% of the time, so the question you have to ask yourself is, have you created a strategy for the other 70% of the time? If you're already a trend trader and your system and trade plan generate enough profits during a trending market, then there's really no need for you to even concern yourself with the ranging market. You're just simply going to wait for a breakout and another trend to be established. But one of the challenges is you're going to have the patience to wait. Most traders don't have that patience. They're going to sit down in front of their computer and feel as though that if I'm in front of my computer, I have to be trading. One of the suggestions I have for trading in a ranging market is really adapt your systems and trade plan by changing your trading time frame. And then you can develop a strategy to actually trade in a ranging market. Well, if you're a swing trader or position trader and you're drilling down to the smaller time frames, essentially you become a scalper. And one of the things about scalping traders that we know is the smaller time frames move a lot faster than the higher time frames. And if you have a sound trading plan and trading system, it should really apply to all time frames and all markets. The only way to confirm that performance, of course, is through backtesting. And to adapt it to a ranging market, you can simply make some necessary adjustments based on your statistics. If you're going to make a change from position or swing trading and learn how to scalp and take advantage of some of these ranging market opportunities, you really need to drill down and practice first on a smaller time frame during some of these ranging markets. One of the things that is key and that I had to learn, traders, is you have to be more adept at using your platform and get really comfortable with shorter stops, shorter profit targets, and faster moving price action. Here's just an example of 2 days worth of trading signals, and I'm starting on the left on a 5-minute chart and moving across to a 1-hour chart. And all of these time frames could actually be considered scalping time frames. But just to show you the difference, based on my rule set on this 5-minute chart, if I look at my RSI crossing my trade signal line, I haven't marked divergence and some of the other rules I have. The same 2-day duration on a 5-minute chart, traders, produce 14 trades. The duration on a 15-minute chart produced 9 trades, and the same duration on a 1-hour chart produced 4 trades. The question is, are you looking for more trading opportunities with shorter profit targets and shorter stops, or are you looking for trades that move a lot slower? Do you have the patience to let the trade play out? Can you walk away after executing a valid signal with confidence in your trade plan based on your backtesting? Traders, I call this time frame viscosity. That is, the 5-minute time frame is like water, the 15-minute time frame is like syrup, the 1-hour time frame is like oil, and the 4-hour time frame is like molasses. I personally find the 15-minute time frame and 1-hour time frames the most beneficial for me to scalp. My rule set and trade plan give me plenty of time to prepare on a 15-minute and 1-hour chart so that I'm actually ready once I get a valid trade signal. My rule set and trade plan perform very well on a 5-minute chart as well, but psychologically, traders, I always feel rushed and hurried, and I'm uncomfortable trading a 5-minute chart. I've mentioned before, I know some professional traders that love trading 5-minute charts and are very successful at it. For me and my personality, I just prefer a 15-minute to 1-hour chart, and I consider the 15-minute and 1-hour charts scalping time frames. And you are ultimately going to decide which time frame you are most comfortable with. Please notice, traders, that on every one of these time frames, of course, the market is displaying some consolidation, and then we ultimately have a breakout, as we know. So ultimately, what's the advantage of scalping? Well, on the smaller time frames, you're going to get more signals. The downside is you have to have total focus and control and be prepared to react to those signals. There are going to be more signals and more trades. One of the pitfalls of scalping, traders, is you can have too many open positions and too much capital at risk, and unless you've done the practice, it can be very difficult to manage several open positions on the shorter time frames. So as you've seen on my 15-minute and 1-hour videos, traders, not long after I enter the market, I place my stops and targets, and I tend to walk away. You'll also notice on my videos that I don't overtrade. We may have a huge rally or sell-off on the euro crosses or the dollar crosses, but I only stick to maybe one or two pair at most. That's all I really need to make significant and consistent profits. I actually find that through backtesting that the 5-minute and 15-minute charts are really good for trading within tighter price channels. And of course, the 1-hour chart I would apply to trading within a higher time frame channel. Let's say we're looking at the 4-hour chart. I notice it's trading in a range. I would look down to the 1-hour and even as small as the 15-minute to take advantage of any ranging on a 4-hour chart. The importance of backtesting in trading and arranging market traders is you need to know the channel range. Is it 30 pips? Is it 50 pips? So that you can set your proper stops and targets. So a 50 pip channel on a 5-minute chart may be very significant. Clearly a 50 pip channel on a 1-hour chart is not as significant. Traders, there are also many techniques for entries, stops, and targets when you're scalping. Some people use ATR, which is average true range. Some people use ADR, average daily range. I tend to use fibs, market structure. Some people are purely indicator based when they're scalping in a trading range. Traders, these are just some suggestions if you find yourself as a trend trader or a counter trend trader not finding too many trade opportunities. Spend some time looking back during some ranging markets, backtesting signals, trading the bounces between the range, and actually making some nice profits. And then, of course, after a breakout and trend is established, you'll definitely go back to your trend trading rule set and trade plan. In summary, traders, there are some options. If you're a trend trader or a counter trend trader, and you have the patience to wait out a ranging market, by all means do so. If that's part of your rule set that says, I absolutely don't trade ranging markets, then by all means, stick to your rules. The other option is to have a system for when the market is ranging and look at the appropriate time frame that works with your personality, establish a range, do your back testing, and then take advantage of some of these bounces that occur within that trading range. All right, traders, as always, great to have you back here at the Pro Trader Network. Thanks again for all your emails and comments. Remember to stay focused, follow your rules. We'll see you next time.